Today we're going to talk about finding the right lender. So what we're going to learn today is looking at the lender landscape, looking at your client's realities, and seeing where's the best match so that your clients have the best chance of getting their application approved. The information in this module will give you just enough to do an initial ballpark assessment of your client, and based on what you know about your lenders, be able to see where the best match might be for them. It's important to start with understanding the landscape of lenders in your area. Who are the small business lenders? What are their products? What are they used for? And what are their basic requirements regarding the 5 C's? Now, you don't need to know all the details, but it's helpful to have a general idea of a lender's underwriting criteria for this matchmaking process we're talking about. What's also very important is to help your clients get the documents together that each lender requires. And we're going to talk about this a lot in this series. It's a document-intensive process to apply for a loan. And lenders require different documents. They require different amounts of documents. Some will say we want 1 year of tax returns. Some might ask for 3. Some say we don't need profit and loss. Some will say we need past 3 years of profit and loss. And this is a heavy lift for the people we want to serve. So it's good for you to know which lenders require which documents. It's also very helpful to know who's making the underwriting decision or who the loan officers are, and can you start having conversations with that person to better understand what they're doing on the lender side. So as clients come in the door, you can say, where's there a good fit here? To do the matchmaking process, you need to understand the lender side, and then of course you need to hop over to the borrower, the client side, and assess their situation. We often work with borrowers who come in the door unfamiliar with this process, unfamiliar with underwriting criteria and how small business lending works, and they can be unprepared or sometimes have unrealistic expectations of what's possible. Part of this module is helping you sort through what the client has available to them in terms of documenting their status, determining if there's enough there for you to match them with a lender. Does the project fall into one of the good reasons to borrow we talked about earlier? Has the borrower done enough research and feasibility to make sure that their project sounds grounded in reality and sensible? Does the project need a projection? Is it a startup or does it have a profitable history? These kinds of questions will help you know which lender might be interested in this project. So one of the first initial assessments you want to do with your client when you're doing this initial matchmaking is looking at the borrower's cash capacity. And this will help you determine how much money your client might be able to afford. Now, there's a lot on this slide, and future modules will give you much more information about how to do this assessment. But for now, let's just suffice it to say that the amount of money your client can borrow is a reflection of your client's current realities, and one of those is cash. So part 1, you might say, of your matchmaking job is helping clients understand the connection between their current excess cash capacity and the size of loan they might qualify for. So the size of loan that they will qualify for will depend on many factors, but a central one is, can they afford the monthly loan payment? And what does that look like? Do they have enough money in their situation to make a $200 a month payment or a $2,000 a month payment or something in between? So that's where we're looking for this thing called excess cash. It's the money left over each month after all the bills are paid. And we will cover that in more detail in the future modules. But if they only have $200 left over after they pay all their bills each month and all their expenses, but are seeking a loan that has a $700 or $800 a month loan payment, you may not have a match that a lender is willing to consider. So again, let me just give you a little information about how loan terms affect the monthly loan payment by moving to a new handout that just gives you an example of this. So if you look at this handout, this is a borrower who wants to borrow $5,000. And in the first line there, the first box on top, you'll see they're going to borrow $5,000 and they have 12 months to repay it, 1 year. So they'll make 12 payments. And the interest rate is 8%. And if you do the amortization of that, their monthly payment is going to be $435. And you might say, oh my gosh, 8% is just too much money, too much interest, a very high interest rate. Let's look for a lower interest product for them. Well, in the middle box, you see they're still borrowing $5,000. They still have a month to pay it back, and the interest rate has been cut in half. It's only 4%. So look at the monthly payment. It's only dropped about $10. So it hasn't made that much difference. But if you go down to the very bottom line, you see, again, they're borrowing $5,000 at the high interest rate, 8%, but they have 2 years to pay it back instead of one. And look what happens to the monthly payment. It goes down to $226. So again, we'll give you more information on how to do this, but you start to see that the rate, term, and amount will tell you what the monthly payment is. And that's where you start comparing that monthly payment to how much cash it looks like is in the client's business and personal financial situation. Once you do that and you calculate the monthly payment for your client's loan request and you compare it to excess cash and start to say, is excess cash greater than this loan payment that I've calculated? Does the amount your client can afford match the project costs? Again, we don't want to underfund a project. So if they can only afford a smaller loan, then we have to go back to the drawing board and think of a new project for them. And again, all this cash capacity is going to have to be documented in some way. What documents does your client have? What quality are they? Are they accurate? How many years back do they go? All of this will impact, again, how much money they can qualify for, because their cash capacity is documented through all these documents we're going to talk about through this entire series. And finally, looking at the terms that your lenders provide in your area, you'll start to be able to say, let me amortize your loan this way because I know lender A provides that kind of term. And then you look at the loan payment and compare it to this cash reality of your client. And again, this is kind of a mouthful. This is just the opening the door to this, and we'll give you more tools around this down the road. So in addition to looking at your client's cash reality, the two other C's we're looking at just in this initial assessment is credit and collateral. So whenever you sit down with a client, you want to pull a credit report with them and start to look at it and say, what do I see here in terms of history, payment pattern, collections, amount of debt owed, and start to see if this looks like a credit report that a lender in your region would accept as a qualified credit history. Then the last C that we're just talking about on this initial assessment is collateral. Does your client have any collateral to offer? Do they have a car that they own outright? Is there business equipment? Is there some equity in their home? That, again, you're trying to match what they have to offer as collateral to what the lenders in your region require for qualification. So here's some additional questions you can explore while you're doing this matchmaking process with your client. How many years of operation do they have? There are some lenders who will fund startups, and startups usually means at least 12 months of sales history to show. Some will fund startups, some won't. Which lender's credit criteria matches what you see on the credit report that you pulled with that client? Which lender's required document list matches what your client can provide in a clean way? Which lender might accept your client's collateral? Which lender has a loan product that matches what your client needs? And which lender is the best match when you pull all this together for what your client needs and what they can qualify for based on their cash, credit, and collateral realities. So given what we've covered so far, which is initial assessment, not all the details, you can see that even this much might be overwhelming for some clients. So let's talk about what you can do to help keep them in the process. You can let the client know what their credit, cash, and collateral realities are relative to the lenders in your area and start to help them see how they have to fit into this criteria. You can affirm the good news and do your best to soften the bad news. You can tell them that completing a loan package usually takes weeks or even months. And I've worked with a lot of business owners who want the money yesterday and think they can get it tomorrow. And that's part of the process of being a coach or a consultant to business owners, is helping them get used to what it really might take to qualify for a loan. And educate the client that they might need to upgrade bookkeeping. That might have to be cleaned up before they apply. Their bank account management might be sloppy. If they don't have a separate business and personal account, keeping their money separate, you want to set that up. If they're spending a lot of money out of the banking account on personal or vice versa, you want to help them clean that up. There could be remedial things that have to happen in order for them to present well to a lender. And so these are the kind of conversations you can have sometimes after this initial assessment. So you can be a positive resource for change by creating a series of services that roll some of this loan application process out bit by bit. And I hope that in this module series, we're modeling to some extent how you can break it down into small chunks that are manageable for your clients. The other thing I recommend is offering a free 1-hour seminar on some of this information. When I was doing this work for a SBDC and a WBC, I found it very hard to relay all this information in a one-on-one session right off the bat. People would come in the door with unrealistic expectations about how fast it would go, what they would qualify for. Sometimes people would get irritated by my questions because I'm trying to do this matchmaking process. And it was just kind of tense. So I found it much easier to offer a 1-hour seminar that lays out at least some basic parameters, that it helps get your clients like in the ballpark of what's realistic. And then when you have your one-on-one meetings, they're in a better place to start moving forward without so much either upset or resistance. So you can design a capital access series, again, that supports clients through this step by step. And then also, this series, I think, will help you assess internally where you have existing strengths on your staff and where there might be some gaps that you need to fill in order to offer a service in a particular part of the process. So if you finish this initial assessment with clients and you see some promise, here's some of your next steps. You definitely want to start developing a loan package based on the information from the lender and what we provide you in this series. And then start to think about which lenders might be interested in this project and maybe call them and say, hey, I've got this deal. Can I give you some information about it? What do you think? If lenders express any concern about the deal, you want to go back to your client and try to fix any problems or issues that were pointed out by the lender. And always err on submitting packages that I would call gray area. There's times you're going to get a borrower coming in the door who just doesn't look like a fit and needs a lot of work. There's some that look like an easy fit, and there's going to be some in the middle. You're not the lender. You don't know what a lender's going to say. So if it's a gray area, go ahead and submit it and just deal with any feedback you get from the lender in the long run. And remember, you're not the underwriter and you don't need to know everything they know, just maybe half. I always say to business development people, if you know about half of what the underwriting knows, you're in great shape, and that's all you need to know to be successful at this. So we've completed this module on finding the right lender, and I look forward to seeing you on the next module, building relationships with lenders.